Sunday, May 26, 2019, Maneco 64, home of alternative economics and contrarian views. I decided to make another video today after yesterday's quite long report because there were a few things that I couldn't cover in that video or else it would have been too long. And there's some more things that I've just looked into after I made the video that I think are quite important. First one is a story in the FT about Bank of England staff. And the story says, BOE staff highlight corporate bond market dangers. And it's interesting because I'm not sure if it was in yesterday's video or earlier this week, I talked about the risk of having a lot of your savings in the financial markets. I warned, especially in the UK, with rates being so low and real rates being negative, that a lot of people are getting involved in corporate bonds, which I'd seen, offering 5, 6, 7%. And I actually said that, that's a nice return, but actually it could, it is very dangerous. And this is quite timely. Actually, now I remember it was in yesterday's video that I talked about that. So now I've got proof from the Bank of England staff about this. The other thing I wanted to cover is Deutsche Bank, which I made a video about earlier this week. Look at the share price of Deutsche Bank. It didn't close very well this week, and it's not looking good technically. And I want to touch upon a story also in the FT about Deutsche Bank's latest shareholder meeting. And before I go on with the subject of the video, I'd like to say that if you're looking to protect some of your savings with precious metals, and I'm not recommending anything, it's just that a lot of viewers ask, in the UK especially, where can I buy precious metals, gold coins or silver? And I have a promo code, maneco64 promo code, with goldinvestments.co.uk. Gold Investments have been in the business of bullion dealing in the City of London since 1981. It's arguably one of the oldest family-run businesses in that field. And I've been dealing with gold investments since 2002. So if you're interested in acquiring precious metals, go to the link in the description below and use the promo code maneco64. If you do call them via phone, give them the maneco64 promo code and you get a 0.5% discount if you decide to buy physical gold or silver. So, corporate bond market. I mean, there's a lot of things out there that we don't know, especially if we're not highly connected in the financial markets, if we're not working in the city or Wall Street. I used to work in the city, but even when I worked in the city, there are a lot of things you don't know. But when it comes from the Bank of England, you need to take note because they are, they are at the center of the financial monetary system. And I would say that reading this story, about the Bank of England highlighting the dangers of the corporate bond markets, in my opinion, they're the biggest culprits. They're one of the biggest reasons why this is happening. So let's go through the article here in the FT. It says BOE staff highlight corporate bond market dangers. Blog post warns of disorderly price moves if conditions sour. So this is by Miles McCormick. It came out a couple of days ago, May 24th. So I'll go into the article. It says, the Bank of England has warned of the potential for dysfunction, disorderly price moves, and losses for investors in the corporate bond market, as it flagged a sharp rise in the volume of securities clinging to investment grade ratings. In a post on the BOE's Bank Underground blog this week, policymakers wrote that a rise in the volume of bonds rated BBB, the lowest investment grade, has materially increased potential financial stability risks in the sterling corporate bond market. The cautionary notes come as the size of sterling investment grade bond market has rocketed over the past 20 years, jumping sixfold since 1998 to 375 billion today. So that's a huge, increase in the UK corporate bond market. I would say a lot of that is because of the easy credit we've seen in the last 20 years and especially in the last 11 years. So just to give you an example, an idea of what that means, 375 billion in the UK. UK, you can see here, this is from the Office of National Statistics. UK GDP, just over 2,000 billion, so 2 trillion. So a corporate bond market, sterling corporate bond market of 375 billion means that that's about just under 19% of GDP, 18.4%. So keep that in mind. It goes on to say, but the overall quality of this debt has dropped, with the share of BBB rated bonds in the market rising from 8% to 50% over the same period. This means that the market value of the BBB market is now 4 times what it was in 2008 and 8 times what it was in 2002. So again, why is this happening? Well, because the Bank of England, they've kept rates artificially low, almost at zero since 2009. And investors with inflation measured as per the CPI or RPI around 3, even 4%, investors need to go and find a higher return than they get in the bank of, maybe at the highest 1% or 0.5%. So that's why this market is increased so much. So who's to blame for that, for keeping interest rates artificially low? So what that means is just the UK corporate bond market, the 50% of that corporate bond market is just above junk rating. It's just at BBB. That means it's around 10% of the UK GDP equivalent, because the corporate bond market is around 18.4% of UK GDP, and the amount of that just above junk is half of that. So it's almost 10% of GDP. So if something happens in this corporate bond market, it could have reverberations all across the UK economy. It could be huge. So that's what we need to keep in mind. That's why, am I advising people to sell all their corporate bonds out there? No. But I think if you do have these securities and you do have some other savings, maybe try to think about getting some real protection, some real insurance in the precious metals. So it goes on to say, it is feared this dip in quality has left capital markets vulnerable. Well, no, I don't want to say the word. If the credit cycle turns, which it looks like it's turning, and the rate of downgrades rises, the volume of fallen angels, bonds that drop from investment grade ratings to junk levels, would be much larger than in previous credit busts, the bank said. Of course it would. I mean, it's gone up eightfold, in the last 17 years. Of course it would have a huge impact. When securities drop out of investment grade category, many investors are forced to, under the terms of their mandates, to sell. Yeah, these are the fund managers, the pension fund managers. They need to get rid of that. This is very important, in my opinion. This is quite serious. So it goes on to say, in a scenario where the downgrade rate of these bonds hit the levels seen in 2002 and 8, The ensuing sell-off could test the ability of dealers to absorb them, the Bank of England added. That's the so-called liquidity. A lot of these dealers, who sometimes are banks or brokers, they will not make a market. Or if they make a market, they'll, their bid is going to be way below where it should be, potentially causing market dysfunction, disorderly price moves, and losses for investors in the high-yield segment of the corporate bond market. In this severe but plausible scenario, investors could look to offload more than 10 billion worth of fallen angels, raising questions as to the ability to find buyers. Sales of fallen angels alone could test the ability of dealers to intermediate the sterling high-yield corporate bond market and result in large and disorderly adverse moves in high-yield bond prices, the authors of the report said, or the Bank of England staff. And it's interesting, it goes on to say, the article, the warning mirrors a similar report in February from the OECD, which said about $500 billion worth of corporate bonds globally could become fallen angels within a year of a downturn. So this is quite serious. And this is in addition to something I've spoken about before, which are leverage loans, which are kind of bonds, but they're not really marketable securities. They're loans made directly to corporations by the banks. So I'm not even covering that. So what about Deutsche Bank? Well, just a quick look here. Deutsche Bank sees support dwindle at shareholder meeting. This is from May 23rd. FT as well. Deutsche Bank shareholders on Thursday evening voted in favor of all members of the struggling Lenders Management Board and Supervisory Board, but the approval rating was markedly lower than last year. At the company's annual meeting, 71.6% of shareholders ratified last year's actions of Chairman Paul Achleitner, compared to 84.4% last year. So things are not going well for Deutsche Bank. So let's have a look at the Deutsche Bank chart, how it finished the week. So let's have a look here. So you can see there in the daily chart, we closed below the December 2019 low, which was around 670. And we closed right near the lows of the week at 638. I think Charles Nenner was talking about 6.5, and that was in euros, not dollars. So I think this is quite significant. We need to keep an eye on this, on Deutsche Bank going forward. So I think when I made my video, we were a little higher than we were here. We were holding on. Before I go, I just want to show you also a chart of the British pound, of sterling, especially with this story about the corporate bond market. You can see here, this is a weekly chart going back to like 2005, and you can see that a lot of the devaluation has been going on, not just since the Brexit referendum in June 2016, but since the financial crisis. I mean, before the financial crisis, sterling got up to 211 in terms of dollars. During the height of the crisis, we dropped to 135. So when people say that sterling is going down because of Brexit, it's a complete fallacy. Sterling has gone down because of the amount of debt that this country has taken, not only through the public sector, but the corporate sector, as we've seen with the corporate bond market, and the private sector. And the only way for the UK to pay off or carry this debt is to devalue its currency. So as you can see here, we are at some key levels in sterling. We have been fairly steady for the last, let's say, 2 years or so, around this 130 level. But I think we're approaching some key support here around 125. And if we break below that level in the next few weeks, we could see another leg down for sterling. And that's why, I think that having some precious metals is still a smart way to go forward if you're domiciled in the UK and you have Bank of England notes savings or fiat currency savings. What about having exposure to US dollar? Maybe, but in the end of the day, I think all the fiat currencies are going to sink against the precious metals. So there you have it. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you a great rest of the weekend. Take care. Bye.